The NASDAQ hadn't even opened when copper futures plunged 7%. Bond yields shot up. The Swiss franc tumbled to a 6-week low, and America's closest allies woke up to a tariff map that looked, frankly, like economic war. At 6:42 a.m., President Trump signed the executive order. Tariffs ranging from 10% to 50% were locked in on 69 countries. Not threats, not warnings. Signed orders, effective August 7th. The G7 had just been redrawn. Canada now faces a 35% tariff on all non-USMCA goods. Switzerland, 39%. Taiwan, 20%. Cambodia, 19%. Syria, 41%. And unlike previous rounds, this wasn't surgical. It was systemic. In Geneva, Swiss farm executives were still celebrating a national holiday when the news broke. Half of Switzerland's exports to the U.S. are pharmaceuticals. Their entire pricing model just unraveled. Ottawa called it a direct betrayal. Mark Carney had met Trump personally just 2 weeks prior to stabilize trade talks. Canada wasn't just an ally, it was buying more U.S. debt than China. Now it was being punished harder than Beijing. That's not an insult. That's strategy. China only got hit with 30%. The same China the White House is accused of currency manipulation, dumping, and systemic theft. The same China with a $295 billion trade surplus with the U.S. last year, larger than Switzerland's, Canada's, or Brazil's. And that's the first contradiction. Allies who finance the U.S. deficit are being penalized more heavily than its biggest strategic rival. Markets didn't panic because tariffs were unexpected. They'd been in the air for months. They panicked because the logic was gone. Brazil, with a modest surplus, got 50%. India, with a larger one, got 25%. No one could explain the formula. Tech stocks fell 2%. Copper, steel, and aluminum dropped. Boeing rose. So did ExxonMobil. Wall Street saw the order for what it was: weaponized purchasing. Buried in the fine print, countries that commit to buying U.S. LNG, U.S. aircraft, or U.S. debt can renegotiate their rate. It's not trade policy. It's a ransom menu. That's not spin. That's a direct quote from Trade Representative James Greer, who said, "Sunday, some of these deals are fixed. Others depend on what countries offer." But the biggest damage wasn't in Asia or Europe, it was North America. Canada sends 78% of its exports to the U.S., worth over $560 billion, nearly a quarter of its GDP. You don't reroute trade flows that size in 4 months. You don't find new buyers for that volume in a year. And now, tariffs up to 35% are hitting key sectors: autos, car parts, aluminum, raw timber, steel. Even if Canada retaliates, the U.S. market is irreplaceable, which is precisely why it was targeted. But here's the deeper contradiction. Canada continues to be the largest net buyer of U.S. treasuries. It's financing the U.S. deficit and getting penalized for the very imbalance it helps sustain. As the U.S. punishes allies, it expects them to keep absorbing the global fallout. Germany, France, Japan, the UK all increased their U.S. bond holdings this year. All now face tariffs of 15% or more. The U.S. built a deficit machine, then turned on the countries fueling it. Now it's taxing them for the imbalance it created. Let's pause, because this isn't strategy. It's inversion. The logic of trade as mutual benefit has collapsed. What we're seeing is protectionism dressed up as debt extraction. Trump's logic is blunt: run the economy hot, inflate exports, suppress imports by force, plug the deficit with tariffs, and finance the fiscal hole with foreign debt. And dare them to walk. But there's one country not walking in circles: China. Unlike the G7, China hasn't retaliated. In fact, it hasn't said a word. While Bessent and Greer scrambled to organize talks, China's delegation, led by Vice Premier Julie Fan, hasn't moved. And they don't need to. Because these tariffs don't just hurt China. They hurt China's competitors. Taiwanese semiconductors now face a 20% tax. Singapore and South Korea, 19% and 22% respectively. China doesn't have to fight. It can just wait. Meanwhile, the U.S.-China trade deal is being publicly pitched as productive, but Greer's own comments undercut that. We pushed hard. We made our positions known. I believe we have the makings of a deal. But the numbers tell a different story. The U.S. trade deficit with China last year was $295 billion. The new deal would shrink it by just $5 billion. That's a 1.7% reduction, less than the typical quarterly fluctuation in agricultural goods. In other words, statistical noise. Worse, the drop isn't from increased U.S. exports. It's from China exporting less. That's not rebalancing. It's mutual contraction. And as exports fall, U.S. consumers foot the bill. In June, the Consumer Price Index showed medicine prices up 8.7%. Swiss generics, over $10 billion in annual imports, now carry a 39% tariff. Prices rise or supplies fall. Either way, Americans pay. But the contradictions don't stop. The U.S. now applies a 40% tariff on all goods transshipped through third countries. That means if China sends goods through Malaysia or Vietnam, and they end up in the U.S., the penalty applies, even if those nations are U.S. allies. The result? Regional supply chains are paralyzed. Importers are freezing orders. They can't tell which shipments might be taxed retroactively. Goods already en route are being hit with penalties on arrival. The Commerce Department says rules of origin are still under review. That's not policy, that's entropy. And in the background, BRICS is moving. At the Rio summit, the BRICS bloc, now expanded to include Iran, Egypt, Nigeria, and the UAE, signed 4 separate currency swap agreements. Russia and India agreed to denominate 40% of their bilateral trade in rupees. Brazil and China struck a deal to settle 70% of their soy and machinery transactions in yuan. It's not dollarization yet, but it's a clear drift, and it's happening fast. Back in 2000, BRICS accounted for just 10% of global exports. By 2023, that share had risen to 23%. Meanwhile, the G7 dropped from 45% to 29% in the same period. And by 2026, BRICS is projected to overtake the G7 in total global merchandise exports. That shift was expected to take a decade. Trump's tariffs may accelerate that timeline, compressing it into just 3 years. Because while G7 members scramble to pay tariffs or secure exemptions, BRICS nations aren't facing new rules, they're creating their own. As the U.S. pushes for reshoring, it's actually prompting Europe and Asia to find new buyers and suppliers. Germany's BASF just signed a 10-year deal to open a rare earth processing plant in India. Japan is expanding its uranium supply chain with Kazakhstan. The EU is negotiating a semiconductor framework with South Korea and a raw materials alliance with Mongolia. It's not decoupling, it's redirection. And yet, Trump isn't backing down. In fact, he's doubling down. A new order signed on July 30, 2025, and taking effect on August 29, 2025, removes the exemption on imports under $800. That means even small consumer items now face full tariffs. Walmart, Target, and Best Buy all issued warnings about fourth-quarter pricing. U.S. consumers will feel the price surge just in time for the holiday season. Inflation could tick up again, and the Fed, already constrained by political pressure, may be forced to hold rates or raise them. Meanwhile, Trump keeps posting. The August 1st deadline stands strong, he wrote on Truth Social. No extensions. A big day for America. Just not in the way he thinks. Because what started as a campaign to punish China has metastasized into a global reordering. A $25 billion bond auction failed just days after the tariffs were announced. Foreign indirect bids dropped to 58.9%, a 6-year low. That's not a blip. That's rejection. So the final irony, the U.S. is punishing countries for running surpluses against it while depending on those very countries to buy the debt that props up its economy. It has created a system that no longer feeds itself, and now it's taxing the feeders. Trump thinks he's cornered China, but in reality, he's cornered America. The only way out may be to collapse the very architecture the U.S. spent 70 years building, just so it can pretend it's winning while it's shrinking. The G7 didn't collapse. It got outmaneuvered. And while the G7 recalibrates, BRICS isn't just seizing the phase, it's constructing a new framework entirely. China's Commerce Ministry reported a 12% surge in yuan-based trade settlements in the second quarter alone. Indonesia and Egypt now conduct over half of their bilateral trade in local currency. India bypassed SWIFT to sign its first long-term rupee oil deal with Iran. The dollar isn't collapsing, but its indispensability is. As tariffs fracture old supply chains, corporations aren't waiting for new trade agreements. They're migrating. BASF froze its $4 billion expansion in Texas and doubled its R&D investment in Gujarat. Siemens moved its data infrastructure from Virginia to Singapore. Samsung is shifting final assembly from Ohio to Jakarta. This isn't diplomacy. It's self-preservation. And the White House's response? Broader tariffs, digital services taxes, financial licenses, cross-border data restrictions, a war on intangibles. But the contradiction remains. The harder America squeezes, the faster leverage bleeds outward. Not through explosions, but exits. Because it's no longer about punishing rivals or rewarding allies. It's about relevance. And in this equation, the question isn't whether BRICS will replace the G7. It's how long the U.S. can pretend the handover hasn't already begun. But the most dangerous shift isn't economic. It's psychological. Washington no longer speaks like a superpower setting rules. It negotiates like a creditor chasing leverage. Trade is becoming tribute. And the collapse isn't of economies, it's of consent. Because once allies stop believing in the deal, it's not the tariff that hurts. It's the silence that follows. We're glad you're enjoying this video. Please like and subscribe.